Assalamualaikum. Welcome to Expert Insights, organized by MCOB, which stands for Allied Muslim Chamber of Business. MCOB is a membership based social enterprise with a mission to create a thriving Muslim business community. It's the power of collective wisdom, continued learning, and thought leadership brought together for Muslims by Muslims. Our core belief is that Muslim business leaders thrive when they have access to a supportive community of peers who challenge and inspire each other. Today, our guest is Javed Iqbal. Javed is Senior Vice President at ZT Corporate, and we'll be covering diversification strategies along with risk and rewards related to private equity. Welcome, Javed.
Hear me? Can you hear me?
Yes.
All
Mhm.
right, great. Thank you very much.
All right. Thanks for being here with us today. Please
Absolutely.
share with us a little bit about your career journey and where you are right now.
Sure. So I guess I can go back as far as my student life. So I am a business finance guy, essentially, and I thought I'll be in a traditional bank position, and that's where I started on Wall Street in New York back in '80s. And pretty soon I discovered that I'm not the desk guy, and not doing the same thing over and over again. It has to be something exciting. So it took me several years and couple of changes and tweaks in my career until from business development, because I people's person and at the front. And then I wanted to run with something that is really, really purposeful and very exciting. And that's how I ended up with ZT Corporate, a private equity company uh,
Mhm.
that has two verticals: healthcare and new car dealerships, two totally diverse uh, um, fields or verticals, right? So I'll take a stop here and let you proceed.
Mhm. All right. So you are an expert in the private equity area. What are the basic differences between private equity and public equity?
So private equity, I mean, public markets, so to speak, right? We all know that, right? These are big public companies, right? Private equity is a relatively new field in the US also, you could say that. Maybe, I want to say last 40, 50 years, uh, you know, and then about 30 years ago, it took off. Essentially, and it kind of caters to the appetite of American market, because passive income, while there are many different opportunities for investors to be able to have those incomes. I'm talking from investor point of view, not necessarily deal structure and merger and acquisition, or from the PE companies. So this is one aspect I wanted to highlight also, is so it gives the opportunity to people like you and me and others to get involved in the mature companies, not startups,
Mhm.
who have credentials. They're expert in their fields, and investors can be part of the venture by bringing their investments. Of course, after due diligence and whatever their requirements are, parameters are, and then be part of that company, let's say as a limited partner generally,
Mhm.
and the private equity company is a general partner, so the one who's running it. I mean, that is essentially one aspect from investor point of view, right?
Okay.
And also, this space was created by entrepreneurs and experts who saw the opportunities and didn't want to go to the usual banking channels first. Typically
Mhm.
businesses would have some of their own equity, and then any expansion would come after going to the bank and presenting them the project, getting their go ahead, and being approved, and then you grow. So private equity, as opposed to that notion, did pretty much same thing for expansion, but it opened their investment to accredited investors in the market. They would still have dealing with the banks, right?
Mhm.
There is banks involvement, there is lending and everything, but it takes a second seat, a back seat, so to speak. The first, the round of investment is generated by investment, and again, it is not essentially a startup situation. It is the tested business model that is running, doing well typically, and needs capital to expand. So that's what happens. Now, it could also be in different, uh, uh, essentially, market segment. So,
Mhm.
for example, our company is in the retail private equity space. Means our investors are the accredited professionals, businessmen, who come and join us. Now there are bigger means it's just by choice. There are private equity companies who would only deal with institutions. As you know, there are hedge funds, pension funds, states, family offices, right? They can write a check for a new acquisition for $500 million or $1 billion or a couple of $1 billion in one go, right? So we are not in that space. We are in a retail private equity space where we love to work with individuals and take them with us and share our good fortune with them. And because they have come through for us, as opposed to banks' stringent requirements,
Mhm.
uh, we are able to raise the capital relatively easy for our projects that we have done all kind of due diligence, internal and external. I'll stop here.
Okay, all right. So, share with us what are the key factors that you consider when deciding to invest in a company?
You mean our company? For example, first of all, you have to be expert in your particular field, right?
Mhm.
So, and I will obviously just for the as an example, I'll keep on referring to the company where I work, but others as well. So, the company was started 27 years ago in the healthcare space,
Mhm.
and that has become company specialty. I mean, not that managers and owners are physicians or anything, right? The business model started in the healthcare facility with an imaging center, uh, when CT scans and others were relatively new, and there was good opportunity, right, as a business point of view. So uh, that the key is to stick in your vertical or in your expert field, right? We did that up until, for example, and some example will clarify it, uh, up until 15, 16 years. And
Mhm.
then investors said, we want to diversify. So can you bring something else on board where we could be happy, keep on investing with you, but give us some diversification as we are able to do go into public market and then invest and have a combination of different instruments in there in our portfolio. So the company looked into multifamily. That is another natural area, and then QSR, quick service restaurants,
Mhm.
um, hospitality, right? But it always helps to be in a industry where you have some entry barriers. That means we also had difficulty, but we
Mhm.
eventually got into the new car dealerships, right? Which is like a big boys club, right? Uh, so it's extremely difficult to get in there. And it was few years of a struggle, and finally we got into it. But the thing is, not everybody can get in it. So for our investors, it is an extremely good industry, which is part of the American automobile industry, along with the home, is part of the American fabric. The home and a car, right? So it is going to stay there. 100-year-old companies like GM, Toyota, and Mercedes, BMW, they have deep pockets and have their own finance wings, so they are not going to let their franchisees go down. So it's a very good position to be in. So long question to your answer. The field, uh, you know uh, it seems to me that has to be where the management can bring some expertise. Okay, so healthcare is a very compliant industry, so
Mhm.
you have to have the expertise, from public policy point of view, individuals' health, and follow the city, state, and federal regulations. While in auto industry, it's not that kind of regulation. It's like a ethical corporation you have to run, but the entry is extremely difficult. So you want to find uh, areas which can be a good investment for the company and their investors.
Okay. From the industry perspective, industry, private equity industry, what are the biggest challenges that you face, and how do you overcome that?
So, private equity actually, if anything, has gained a lot of acceptance over the years. It has become a recognized or acceptable mode of investment for many individuals, right? Uh,
Mhm.
but the private equity operates in the same space like any other businesses. First of all, unlike many private equity companies, they can sometimes they raise the capital and
Mhm.
then maybe they take a board seat or some influence in a company, and then they're happy with that, and that kind of situation can backfire because uh, there's no hands-on or day-to-day control over the company, right?
Okay.
It's only from management point of view, partial, right?
Mhm.
While in that's another reason we are in the retail private equity space, that once we acquire, we raise, and then we manage it ourselves. So that was a challenge we overcame by running those businesses, whether in healthcare or new car dealerships. Companies are owned by us, and we run them. So that is so that's how we can also be accountable to investors as well, right? So this situation um, solves many challenges that this industry has uh, from operations point of view.
Okay. All right. In the overall industry, where do you uh, what's the usually deal size in a private equity in general?
Yeah, so again, based on the classifications, right, and what space is being utilized. Since these are mature business, not startups in private equity, on the upper end, it could be several $1 million, $1 billion deal, be with a B. That happen all the time as well, and then there are medium-sized companies. Our sweet spot is about 100 million, right? Because at the end of the day, for example, we raise capital
Hmm.
uh, from accredited investors, which could be anything upwards of $100,000, right?
Hmm.
But interestingly enough, we are able to do it because with the current investor and some new people join us also. So
Hmm.
that is the spot that we found for us. It works very well, but there could be any range, and on the very low end, you will see the same thing happening where somebody is bringing a deal, and it could be a few $1 million, right? It's going to operate on the same principle, essentially. A general partner, a limited partner, right? And then close the deal, and then uh, pay individuals either ongoing or at the end. But it could be as little as a few $1 million and few $1 billion.
Okay. All right. And would you be able to share some example that you have seen in the industry or through your company where you took the company, acquired it through private equity, and then took it to multiples of like whatever those multiples are, 5, 10.
Yes, yes, I love that. That is great. Yes. So one of the example is uh, when we diversified. Remember, I mentioned that into auto,
Yep.
right? Uh, then the we knew it's difficult to get in, but we had a team of from the industry expert. For example, president of the new auto division
Mm-hmm.
was someone who was president of a big dealership earlier, right?
Mm-hmm.
So and then you have to work with the manufacturers. You have to wait for the opportunity because these dealerships are not for sale every day. The only time they become available is maybe family after 2 3 generations, because these are all private businesses. You can look around in your town and see the same dealership for years and years and years, right?
Mm-hmm.
um, uh, Rarely it changes hand, when there is no succession, or family has become too big, or second third generation, and they want to cash out. So we got an opportunity, and from a physician who was retiring. So he was physician by profession, but he inherited the dealership from his family, right? He was practicing physician, and he had no succession plan, right?
Mm-hmm.
So, and now that we were in and looking, and for a few years, finally we got told, and that deal it came through for us, right? Now, this was a little bit of background. So our investors, we always give a projection, right? Obviously, if somebody is investing, and this will answer your question. So uh, typically, our presentation is for that particular deal was that after acquisition, we will. Because it's a new addition, a vertical to our business.
Mm-hmm.
So we will start distributing. We'd like to pay out, for example, two ways, right, to investor. One from the distribution, the cash on cash, the dividends ongoing, and the one is the upside, right, that is created after we sell it. So we said, we will be distributing after X amount of time, and then we will sell it in 7 to 9 years after some more acquisitions. And you can expect, and I will stay away from, quoting too many figures, but, at the end I will put one, so just in the interest of being neutral. Uh, so we gave them a projection of what we expect, or what they can expect yearly to receive from us, and then
Mm-hmm.
also after we add few more dealerships and will exit, and the projection we gave them, right? So lo and behold, we were able to grow it nicely, added a few more dealerships, right?
Mm-hmm.
Names, right? And so we were in 3 states, and it was around 9 years. Okay, this is after COVID, right? Things are still recovering. So our investors said, "All right, ZT. So we there was a plan. Okay, we can understand a little bit delay and everything. So what's the plan? Are we, exiting?" So we discovered, we knew it's difficult to get in, but we also discovered this is a great asset to have, right? So better to keep it. So we floated this idea to investors that, okay, if we all stick together, there is already a dividend distribution model happening to you yearly, which is attractive in us that it beats most conservative public markets, right?
Mm-hmm.
High single digit return yearly. uh, we can either go public in few years, right, or we can keep it for longer time, and this is like a cash cow, right? It's working very well. So we think our thesis, what we had, it needs to be tweaked a little bit. It'll be better to have this asset, right, for longer time. And of course, we always, all the limited partners, we listen to them, their feedback. So they said, well, yeah, but the thing was, the key point was the exit after X amount of time, right?
Yep.
So now we now I'm giving two examples in this case to you. One, answer to your question, if we have done a full round and how did that go. Secondly, I added a little bit of a unique situation where company now didn't want to exit, so to speak, or
Hmm.
thought it's a better idea to keep it. Uh, of course, for investors, for everybody. Uh, but we had to come through. So essentially, we got a third party valuation, nationally known companies, not one but two, right? So where we found out what is the value and the growth that has happened in the last 9 years, uh, and then everybody was offered a buyback situation. Okay, it's like selling the company, right?
Yes.
Right. So it was a created exit for them, right? So everybody was paid the market value, what we will get from the market, right? So that company can do that too, right? Because we
Yeah.
wanted to, play with it. So, and they were paid back. So now I can, I mean, if you are okay, I can quote a figure. If not,
Oh,
then
sure. Yeah.
yeah, yeah, okay. So essentially, it also works. We had round one, round two, people who came in the beginning, then the people who came as a second acquisition, and so on, right?
Yeah.
They so these are not separate. These are separate acquisition, the dealerships during the years, but they all became part of the same big portfolio. So it was one company, right?
Okay.
So, so they all made different, returns. The one who were there longer made less because the proceeds got divided by the number of years, and the ones who came later actually made a better return. So most clients made about mm, I want to say up more than 35% yearly return.
Okay.
Right, that was a great deal. And this round of investor, particularly I'm talking about, was no more than 4 years, right?
Okay.
So investment, the second round, yeah. So that's what happened, and so everybody was happy because the exit was really good, and when I say they made 35% plus, that includes both the ongoing dividend distribution and what came at the end. You combine those and see what your yearly return on investment was, right?
Okay.
So yeah, so we still, company still has the dealership, which is, you could say, is owned by the company or few general partners now, right?
Mhm.
Not there were 415
Yeah.
limited partners in it, right? Who were all bought back, and they were paid handsome amounts, yeah.
Mm. Okay. So when a PE firm is going in to buy a company, I'm
Right.
sure there is, and you mentioned that there is an exit plan. How
Yeah.
long usually it is? Like, how many years do you see that? Okay, in 3 years we are going to exit. 5 years, 10 years. What's
Yeah.
the average then?
So depends upon industry, the deal structure, uh, but typically, I want to say 5 years is what we have found, again, to be a sweet spot in our kind of companies and industries, because
Mhm.
you cannot create any value in a business, in a big business, in a year or two, right?
Okay. Mhm.
Right. So and although our model is probably one of the fastest one, where we keep on acquiring the same things. If we are in healthcare space and we are acquiring urgent care or freestanding ERs or hospitals, we're gonna acquire more of them, so that we can not only grow the business, but also the efficiencies that are created also yield better results, right? Same chief medical officer who looks at the credentials of all physicians who are employed by us, he can handle another 10 physicians, right? The supplies, what have you, so everything. So same in the auto, we keep on doing the same thing. So that 3 to 5 years is our the time where we are now able to do it, right?
Okay.
um, uh, Earlier it took longer because it was a new industry and we had to be there, right? So now it is entirely possible that the projection that is given is 3 to 5 year, and let's say it's the fifth year,
Mhm.
and company looks good as a asset that needs to be sold. It's propped up, systems, procedure, technology is good, and it is in the market now, so that it can be sold.
Mm-hmm.
It is possible that 2010 or 2020 happens, and this time frame is it doesn't pan out, because in that case, if something happens, there are not going to be too many motivated buyers in the market, right?
Mm-hmm.
So during uncertain times, so it's going to be hard to sell. So it could go, it'll be another year to two before things get back to normal. Everything is cyclical most of the time, right? So things do come back. We have seen it after COVID now again, right? Uh, the travel, the hotels, overall industry, they're doing really, really well, right? So yeah, so timing. That's why we have to give a range, and it could also change a little bit. By the same token, it could also be a little earlier than planned as well. I mean, if we have a national seller who wants their footprint, let's say in the state of Texas where we are, right?
Mm-hmm.
And we have something to offer, and then we get an unsolicited offer, which is around our target exit
Mm-hmm.
or more. We'll take it in 2 years.
Okay.
Yeah.
All right. Sounds good. We have a question from the audience. Does your capital structure include bank lending as well?
You always have to deal with the, thank you, good question. So we always have to deal with the bank, right?
Mm-hmm.
So this is what we do. I'll give you a typical scenario, and it'll be more clear. So we essentially, when we are going to acquire another asset,
Mm-hmm.
we will make a, for there'll be LOI, contract, everything, and a price, right? And then, like anything else, we will ask for closing time, right? Which could be 3, 4 months, whatever maximum seller can give us, right? So
Yes.
we are going to run with that figure, and I know I'm in the capital raise department, so I know, right, how it works. The M&A department, presents us, okay, hey, the board has approved, and this is what it is, and we are going to acquire these assets. It's going to be a really great buy for the company and its investors,
Mm-hmm.
okay, and it's $75 million, okay, but we only got 3 months from the seller, okay. Now, during that time, we raise that capital. We have relationships, right, nationwide,
Yep.
So, and many of investors are waiting. So, we are able to raise that, but we always talk to the bank, right?
Okay.
In case we have to close, and we are at 90% of the raise, we
Mm-hmm.
are going to take, yeah, we're going to take the money from the bank. Yeah,
Okay. All
yeah,
right.
yeah.
Any particular industries that you see right now that in the next 3 to 5 years that would be best to invest from PE perspective?
Wow, that's a very big stage. It's difficult because there are industries that could be suitable, and you need expertise for every industry, right?
Mm-hmm.
Uh, one up, but I'll still try to answer it. Not in the too distant, I'm not sure, but I think currently
Mm-hmm.
one something that is could be a good buying proposal is the hotel industry, for example. The hotels in the last few years uh, were bought, the branded hotels we're talking about, 2, 3, 4 star, at a higher multiple because they were doing well. And then typically, other than companies or holding companies own equity, which could be, 15, 20, 30%, right? Rest of
Mm-hmm.
the money, came from the bank, and they were financed on a variable interest rate. Yeah,
Okay.
interest only, right? So while it was good at 3, 4%, right?
Mm-hmm.
The rates were not too long ago, right? 2 years ago, right?
Yep.
Uh, but with the rates double, actually they went into double digit for these commercial entities. We didn't see it, right? But the companies, some of them ended up paying interest only, maybe 11, 12%, right? think about going, from 4% to 12%. That is three times the more. So no matter how, okay, I'm
Javed.
here. Yeah, no, I'm here. Okay, sorry. So no matter how, let's say the occupancy is full, right? We know that everybody started traveling and everything, even during the full occupancy, that entity, the hotels, were not able to service their debt to the bank because now they're paying three times more interest on 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 three-quarter of the assets value, right?
Mm-hmm.
So that those are in foreclosure or receivership, or some owners are walking away, right? Simply because it's just not easy to handle. But if somebody can, if there is a fund that is like cash raise,
Mm-hmm.
especially no leverage or very little leverage, let's say in cash, and those assets are bought from the bank at a discount, right?
Mm-hmm.
So all of the bad debt is gone. Now the books are clean, and these are cash, buy properties. Now suddenly that occupancy and revenue that has been good now, right? It's extremely attractive. It starts making all kind of profits, right? So I think there is a small window until market dynamics change, right? So that's one of the area I thought, is pretty attractive.
Okay. All right. Sounds good. And then just the last question came from the audience. When you acquire a new asset, how do you determine the operator? Do you have a team of CEOs that operate that particular asset for you?
Oh yeah, thank you. It's very relevant to us. So we only buy assets that we have expertise, i.e., our two verticals are healthcare, and we have our own team, and then we have auto, just like normal dealerships, right? And so we have industry experts in there who have lifetime experience of managing dealerships, throughout the country, right? And typically when we buy a new asset, a at the top level we are going to have that expertise. B, those assets, since they are cash flowing and they're running,
Mm-hmm.
they will come with all the staff and all the personnel, right?
Mm-hmm.
We are just going to give them our new management system. Think about it, buying another hospital or buying another dealership, right? So we buy it with the business as it is, right?
Yeah.
So we are going to let them know how we operate, what are our expectations, right?
Mm-hmm.
And that so that way we don't need to look for talent, and our philosophy, our objectives are already set at the top level, right?
Okay.
And that is, just goes down to every employee, and we are able to. We don't have any shortage of employees. We don't have to look for, employees or even managers. Yes, expansion if it requires. I mean, some changes we do it, but we are at an extremely good place because we're doing these things over and over and over again.
Okay. All right. Thank you, Javed, for being with us today and sharing your insights related to private equity industry. I hope the audience has got a lot out of it. And thank you again. Thank
Well,
you for
Kashif,
being here.
I want to thank you for your time on a weekend. That also happens to be long weekend. Yeah, and a couple of time technical difficulties, but it's all good. I'm honored to be here and available to you and your audience. Thank you so very much.
All right. Thank you.
Bye
Sonic.
bye. Bye.